All right, I'm going to start the webinar. All right, thank you everybody for joining us. We're going to start in a minute or two. We're going to start exactly at 8 a.m. So we're just going to wait a minute or two for everybody else to join the webinar. So thank you guys.
Brandon has muted me. Hey, I just wanted to let you guys know that I have a kind of a hard stop at 9 o'clock. That was unexpected until 2 days ago, but I do have something I need to get to right at 9 o'clock. I'll go back on.
Yep, we will stop exactly at 9, so it should be okay.
Hey, delay for a minute or two. My tenant just walked in here with a bloody head. I've got to help him put a Band-Aid on his head.
Welcome to Real Estate 101.
Yeah, you don't hear that every day.
No, the things we do.
Yeah.
Uh-oh. He's muted. We all wonder what he just said.
We all wonder what he just said. In the office, when you talk on mute, you got to pay $1 into the till.
Very true.
That's COVID party.
Hopefully his hands aren't covered in blood. Oh.
You're on mute.
He took care of it himself. Crisis averted. Thank you.
All right, well, on that note, I think we'll get started. Thanks, Jeff. So one, I know that we are expecting probably well over 100. I think we had about 160 folks that registered. We're, I know that there's a ton of folks that will still be logging in, but we're going to get started with our October chapter meeting. We've got a great discussion with a great panel, and I'm going to let Jeff Burd introduce the group in a little bit. I just have a few announcements before we get started. One, obviously, this goes without saying, our Gavel sponsors are key to these events. They are, they allow us to put these events on, and when we're back in person, to maintain them as free events with a full breakfast for our members. They are key to these events. And just so everyone knows, in 2021, we are moving to the Rivers Club, where we are expecting to even allow even more members to attend our chapter meetings for free with a breakfast and all of that. And that's a part of the reason of the move. Obviously, we are watching what's going on at the national level with the virus, like everyone else is. we're going to make a call that as soon as there is vaccine news and as soon as it's most viable, we want to get back in person as soon as possible. I think we're going to maintain a live stream for most of our events in 2021. So for anyone that is uncomfortable with attending our events in person in 2021, they can watch from their home just like a lot of us have done. But more to come on that front, but want to thank our Gavel sponsors. We are in renewal season, so I'm hoping they all renew. And if anybody out there is interested in a Gavel sponsorship, please let me know. This is the agenda of the day right here. We're going to have the introductions in a minute, and then obviously a panel discussion, and then the last 15 minutes, we will open it up for questions and answers. There's a Q&A bar. Please submit your questions there. I know that there's a chat box as well, but the Q&A bar is easier for us on the panel. And then this last thing is really about membership. One, it's renewal season. You should be receiving email and hard copy mail to to renew your membership. We're trying to get well over 90% of our members renewed for 2021. And then the other thing is, if you're not a member, it's a great time to join. From now until December, you get these last 3 months free, and then you get all of 2021. So if you're not a member, this is the time to join, because you're going to get about three months free of membership. So with that, I'm going to turn it over to my friend Jeff Burd, and he is going to introduce our great panel, and I'm excited about the topic and the discussion.
Thanks, Brandon. Good morning to everybody. The genesis of this particular chapter meeting of this program is the fall Developing Pittsburgh, which is, for those of you that are not aware, is NAIOP's Pittsburgh's magazine. A couple of the board members found several of the articles worthy of deeper exploration and suggested that we devote a program to it. I always find that a bit surprising that anybody A, reads what I write, and B, finds it interesting. And to the extent that that's true, it's because of the really smart people that end up talking to me, and I get to write down what they say. We've got 4 of those very smart people with us today. They've very graciously agreed to forego their full introductions in their bios. If you would Google each of their names, you'll see why that will save us a lot of time. They're very accomplished people, and I highly recommend that you do that so you can understand just how qualified these 4 folks are. So the introductions will be extremely brief. In alphabetical order, Kim Ford is the CEO of Rise Pittsburgh, formerly Found Advisors and Crisis Partners. Paul Griffith is the Senior Managing Director and Market Leader for Newmark, Knight Frank Valuation and Advisory. Steve Guy is President and CEO of Oxford Development Company. And Nick Matt is the Senior Managing Director and Co-Head of the Pittsburgh office of JLL Capital Markets. The theme that emerged from the articles in Developing Pittsburgh that was I guess you'd call it a sub-theme that I wasn't expecting, was that this time so far anyway, and that so far was in July, this economic situation we're in is different from that we found ourselves in 2009. Now, that's 90 days ago already, and this virus has proven to be extremely dynamic. So one of the things we should check in on is it still that different? But before we begin the discussion, there were some data for comparison purposes. The recession that we got into because of the global outbreak in February and in March was the steepest that was ever recorded in the US. GDP declined by 5%, and then 31% during the first and second quarters on an annual basis. By comparison, GDP declined 0.3% in 2008 and 0.8% in 2009. And the steepest quarterly decline in any of those 2 years was 3.9%. And we've seen that at the regional level, the same kind of activity. But what's interesting is that in terms of construction and development, that it's expected at this point anyway that the activity is going to drop about 30% from last year to this year, and probably remain there through at least most of 2021. That seems to be right on target to what happened in 2009, when activity dropped 29.5% from 2008 to 2009. So I guess first, before we get into your specific areas of expertise, I wanted to sort of go around the panel here and in a sentence or two, do you see this as being different from 2009, and sort of what's the main thing that jumps out at you that this panel or this recession is different? Perhaps let's start in alphabetical order. Kim, what's your take on it so far?
Yeah, I'd say the biggest change is that companies, their demands are changing. And that's been very clear. I think that the demands that are coming out of COVID and this circumstance are completely different than anything we've seen before. And I think we'll talk a lot about that today as well.
How about you, Paul? You're muted, Paul.
One, I think there's distinct winners and losers, with some property types not doing as bad as others. And secondly, the availability of liquidity in the market and the low interest rates present a different issue for real estate.
Steve, what are you saying different, or are you?
I'm going to echo what Paul said, but I'm going to add to it that the uncertainty regarding this historic event of this particular pandemic is that no one, regardless of planning, really knows how to deal with an endpoint, how to project an endpoint at this point in time. We just got to have a little bit of faith.
And Nick?
Yeah, I think it's what are the psychological effects coming out of this and when we come out of it. And, I think in the great financial crisis, we threw a lot of money at it, lower interest rates, but it was financial. This is financial and psychological. And when are people going to travel again? When are people going back to the office? And that's going to have a big impact on real estate.
Very good. All interesting points. So we'll do something that I imagine Paul would think would be how all things should be done. We'll start at the beginning. What are things worth? So I guess I'm going to ask Paul, what assumption are you making right now, given all those great points that were just made about how property values are holding up, and have you been able to place any values? Obviously, transactions slowed down. How are you approaching the idea of valuation at this point?
We've looked at it, I think, in two different ways, and going all the way back to April. The first 60 days, really trying to understand what was going on in the market and what property types were being impacted. And what we found was that, there was really a continuum with properties over on the multifamily and industrial side being substantially less impacted than properties like retail and hospitality. And that's pretty much held true throughout, the last 6 months, but there's been more nuances relative to, what exactly has happened underneath each of those. And then, excuse me, the second thing is we've really found that there's really three buckets of value impact. One is looking at, is it a temporary value impact where you're going to lose income because of changes in vacancy or declines in rents for a short period of time, but then things will come back to normal in, I think, a relatively short period of time compared to the previous, during the financial crisis, when it seemed to go on and on and on. The second bucket would be, is there a change that's more significant and long-lived, where there's a long-term change in value for that property? And the third is more of a permanent overall impact, where maybe the property type and the use that the property is being put to, that's no longer viable. And you're looking at a different use, a reuse, some kind of adaptation of that type of property. Those properties in the last bucket were typically marginal going into this, that they were plugging along, doing what they were doing. And this became a tipping point so that they're going to find themselves with some kind of a new use going down the road.
When you describe those buckets, were they specific to the property itself, or was it more specific to the property type?
It begins with the property type, and then again with the nuances below that. I mean, the property types that are going to have more temporary impacts would be multifamily, where you may have increased collection loss, or maybe a lingering vacancy, or the turnover time takes a little longer, or market rents aren't increasing as fast. But it's something you would expect to restabilize at its original value or February value in a reasonable period of time. You know, at the other end of the spectrum might be a shopping center that doesn't have a grocery anchor, and it's more a mix of retail tenants. And those tenants become more viable to just an overall decline, to go out of business, bankruptcies, and the whole mix in the center might end up changing. The use of the center might end up changing, and that could be, you know, a rather substantial long-term value change. And then, of course, with lodging, you know, everybody hears about the TSA numbers still being in the 35% of what they were a year ago. I mean, we're still seeing occupancy rates in the 25 to 35% just about on every lodging property that we've been looking at. And, you know, you look at 2023 as a rebound. Well, it seems like, if, you know, between now and then, that's such a long time, that you're really going to see some fallout coming out of that, and really a reorganization maybe of how the lodging industry works, and who the winners and losers are.
Nick, this obviously bleeds into your livelihood very strongly. The value of the properties has just a slight reflection in terms of the financing. How are the capital markets responding? As you alluded to in your remarks, capital markets basically went into cement in 2009. How are the different markets responding at this point?
Well, tough part right now is transactions are obviously down substantially. I mean, just a couple stats. Year-to-date August 2020 versus 2019, hotels sales down 69%, retail 45%, office 43%, multis 37%, and industrials only 3%. So we obviously move towards this omni-channel distribution. You know, last week, JLL nationally signed up 1.44 billion of loan transactions. That's across the country. 48 deals, 34 of them were multis. Only 2 of them were retail, 5 were office, and 4 were industrial. And of those 48 different lenders, 40 were agency or banks. So not a lot of transactions. Lenders are extremely conservative right now, as you would imagine, and people are trying to find the bottom, if you will.
What are some of the differences between how the different lenders or equity partners, let's say the life insurance companies versus the banks or CMBS? Maybe we start there. Is there a CMBS market at this point?
Barely. So year to date September, there's been $43 billion of CMBS done. A lot of that was front loaded. Year to date last year at this time, 59 billion. So we're down 27%. Historically, CMBS has accounted for about 14 to 20% of commercial loans annually. Right now in the second quarter, that was 1%. Life companies, as you know, are conservative by nature. So they've always been lower leverage, best sponsors, best properties, great tenancy. So who has stepped in to fill the void has been banks. And here in Pittsburgh, we're blessed that we have great regional and local banks who have stepped in and done deals.
Well, speaking of doing deals, Steve, your little outfit has continued to develop projects. It's easy for me to say without a bump in the road, because obviously I'm sitting outside your office, not in it. But you have started several projects since the pandemic started. That suggests you're not thinking the commercial real estate market is going away anytime soon. What is driving that? Is that an accurate perception of how Oxford sees the market, and how do you see the demand recovering?
It's more or less accurate, but I think that development right now is very location and market specific. You have to have the right product in the right place. The places that we are developing, primarily what we're moving forward with is in the Strip District, which has been very hot, and there's quite a bit of demand. Remembering in our industry that we build assets to stand the test of 40 to 60 years in an investment cycle. What we see is a recession, and recessions are typically shorter than expansions. 8 months, 12 months, 14 months, you come out of these recessions, and typically your users are ready to do something. They're ready to grow, they're ready to change. They need to make a statement to the marketplace. And we want to have assets that are available to do that. We are absolutely blessed and fortunate to have great financial resources and financial partners, access to lending capital. We have great lenders with confidence in the marketplace who continue to allow us to move forward with our projects. That being said, what we've seen since the middle of March is a period in time that goes from dead silence, you could hear a pin drop, there's just nothing being talked about, to the period in time where you start to hear hush whispers in back rooms about what do we do now? Do we contract? Do we expand because we need different types of social distancing and separation in the office? What is the efficacy of continuing the remote workplace? And are we productive? Are we collaborative? Are we innovative? Can we mentor young people when you're simply sticking them in their bedroom to work for us once you hire them? And the answer is, in June, people were saying, this is working pretty well. And you look at recent studies of CEOs across the country and COOs across the country, and they say, this just can't be the normal. There may be some, but there's not the total. So what we're starting to see right now is this analysis paralysis that existed in the marketplace starting to come up. So we're in a third level of conversation in this pandemic, and that is the brokerage groups representing tenants, both tenants in place and new tenants in the marketplace that have a business model that needs to move forward, that has been on hold, coming out and asking the question, what do you have for me? And how is this going to benefit me? Is your product going to facilitate retention and recruitment? And when can it be available? Because I'm still not sure what I'm going to do. Our perspective is that there's a lot of tension in the market toward going from this analysis period into an execution period. We think that will be accelerated if there was to be a demonstrable vaccine disclosed and a timeline put to it. I think people would have a lot more ease with execution. But right now, we're not seeing a lot of execution, but we are seeing probably tenfold activity in the marketplace in conversations than what we saw in July and August.
Wow.
That's just 60 to 90 days ago.
Huh. Well, you guys are making this segue very, very easy. It almost looks like we knew what we were doing or practiced this. Kim, this kind of bleeds into your area of expertise. The tenant, the user, you and I talked a couple of times this year about what was going on the really on the office user side, and you've stressed flexibility. now that's become a buzzword. And I can recall you and I having a conversation where I asked you, when was that ever not important? And you emphasized that that was in fact the case. How do you see this playing out now in terms of the flexibility required by landlords, and you know, how does someone respond to the need for flexibility when there's so much uncertainty?
Yeah, no, it's a great conversation we continue to have. And I think Nick really hinted to this in many ways, but private equity and venture capital has really dried up for a lot of high growth and emerging technology companies. So if a company wasn't already through the next funding round, or you know, doesn't have a really strong funding round base currently, they're going to really struggle to raise capital right now because capital has turned conservative, just like it seems like in all other areas of capital markets. That being said, today's company and these high growth companies, you know, and I think Steve's seen it firsthand, you know, they're in their Series B, Series C round, and they're raising millions, if not, you know, valuations are in the billions, and they're doubling or tripling in size very quickly. So it's really hard for today's tenant to come into a property and say, let's just say they're a seed stage company, hey, we want to sign a 5, 7, or 10-year lease in a brand new building in the Strip District, because they can't. They can't even forecast 6 months out, let alone 3 to 5 years. So, and then you take the, you know, the companies that are more established and maybe they just did a Series A, they're not really necessarily controlling every decision. These companies have investors, and pretty powerful investors. Think of Petuum. I think their last round, I think they're at 108 million and fully funded by SoftBank as one of their investors. But those investors are making a lot of those decisions. So landlords are going to have to somewhat adapt to these emerging and high growth companies so that they tell the story, so that the investors understand it, and so that those companies have flexibility going forward. So I think landlords in many ways are going to have to adapt, and potentially, if they can't sustain the growth of these companies, they're going to have to do some type of maybe buyout of the lease halfway through if they can't build another building that's going to suit their needs. And, you know, we've worked with Steve a lot in the past, and firms like his, and they have been flexible with these types of companies, saying, if we can't get you the right size space, then we're going to let you walk at some point during the term, because that it's just tenants' demands have changed. So many of these companies have seen the benefits of co-working, because co-working enabled that 12-month lease to grow. And nobody really knows where this future is. So I think the more agility a landlord can provide, the better. The other major change I see is that I love that period of the lease transaction, the deal, when, you know, they request the tenant's financials. And, you know, that's always been a piece where, you know, at least we always prepare our clients for that. Hey, they're going to review your financials. This is what they typically expect. But I think with COVID now and some landlords, I think the tenant may be requesting the landlord's financials as well. I think there's going to be some concerns down the road. Sorry, Steve, put earmuffs on right now. I think there's going to be some concerns down the road that some landlords just don't have the money, or they lose some major key tenants. And, you know, do they have the money left to keep and maintain that property? And so this is going to be an interesting transition period where it might be mutual, you know. The landlord requests the tenant's financials and the tenant requests the landlord's financials. This could be, you know, they need to know that if they're going to sign a 10-year lease, that the landlord has the money to maintain that property.
Let me respond to a couple of things that Kim said. First off, bring him on, Kim. I'm ready for him. The concept of letting the tenant walk and some of the subleasing activity or the release of leases, you know, in the sectors that we work in the R&D sectors and the technology and the high growth emerging companies that have really been a big driver in many parts of the submarkets in Western Pennsylvania, particularly the fringe of the CBD of Pittsburgh. A lot of that has taken place, and I'll speak strictly to the Strip District in what we've done here over recent years. There is a lot of shuffling, there's a lot of upsizing, there's a lot of downsizing. But we don't let tenants just walk, but it appears that way. But because there is so much demand out there looking for very similar types of space, because there is synergy because of the type of expansion going on in the marketplace. So we're able to accommodate folks who need to downsize because of their life cycle or need to relocate because of their life cycle, by bringing in other like companies who can reuse substantially the build out and structure of the space because their needs are very similar. The differences you find are companies that need very unusual tech flex and different things, very demonstrative spaces and tinker spaces. And that is why we've added 2-3 crossings, substantial tech flex capabilities coming online in the marketplace in Factory 26. But for the most part, these tenants work with one another and help one another by moving in and out of the market.
You raise a property type there that 2 years ago, not sure anybody even would have said the phrase tech flex. And now every third project that's been announced is a tech flex. Is that substantially different than what, to some degree, you developed early at 3 Crossings, or what RIDC did 40 years ago? And how does that help the marketplace or the landlord side of it?
I think the tenants and the technical folks at the tenants have decided that while they can code and program and have meetings and come up with all kinds of theories and strategies, they like to see a little more closely some of the impact of the things that they do. So when you have a robotics, those analysts want to see how that robot moves. And rather than go 30 miles out into the hinterland, into a space that you have rented, to have something across the street or down the hall, makes more sense for more frequent opportunity to view the actual results of your work. And it also allows the groups that are actually tinkering and putting things together and fine tuning the physical asset to meet with the technical assets of the technical minds inside the tenants. And it facilitates that innovative discussion that these people have in collaboration.
Hey, Jeff, I absolutely love the definition of tech flex. And I've been, tweeting, chatting with a lot of folks all over the country about this, because many of them have never heard that, that word. And the way I defined it is tech flex is flex space in a good location for double to triple the price. And I say that in the nicest way, but really that's what it is. It takes that really great location like the Strip District or East Liberty to be able to pull off a product like that is, flex space for a tech company because they want that location.
Hey, Steve, relative to the depth of that market and the sector that it applies to, is it more than just the robotics, and how deep do you think it is?
It is more than the robotics, the folks that we speak with and are working with. How deep do I think the market is? I haven't seen a bottom to it since, for example, since announcing Factory 26, which is located at the corner of 26 and Smallman. It's a reuse of a 54,000 foot former warehouse factory building. We have had a constant stream of inquiries and requests for proposals. It's just been constant. So I don't know the answer to your question on depth, but I do know that the answer to the question, if you were to ask about how much opportunity is there, and I would say unknown but significant.
Yeah, we just put a sublease on the market over in Lawrenceville, around 40,000 square feet, and very true tech flex, and the interest has been significant. We just listed it and we've had back-to-back tours. So there's absolutely demand for that type of product.
And inside the space too, you should know that tech flex includes a very, very difficult pricing strategy because the flex type space versus the office and analytic type space is priced differently, and then you have to meld the two into an occupancy cost that makes sense and explain that. But it is something that I think that the tenants, largely because they're representing brokers, understand are getting their hands around pretty quickly. But as a general rule, most tenants scratch their head at first, and through the help of their consultants, get their hands around it pretty well.
So the two finance guys here, I see we've got our poll launched. this sounds like a dream come true. Tenants can come and go as they please. We really still trying to figure out how much this costs. Please be flexible. Nick, how does this sound to you if you're trying to take a deal out into the market? Is this something that frightens the hell out of you, or does it give you more options?
I think it's good from the standpoint of it's a good story with our eds, meds, techs, financials. I think the one headwind we're going to have here locally is, although that product type is specific and pretty tight, lenders typically look at the submarket vacancy. And when they underwrite a vacancy reserve, they're going to underwrite the greater vacancy of either the property or the submarket. So, when you start looking at our CBD Class A vacancy at 20% and Class B at 18%, and 1.5 million square feet of sublease space coming onto the market, and another couple 100,000 potentially coming by the end of the year, you can have a full property and you're taking a 20% hit right off the bat when the lender underwrites the deal. So that's the headwind right now. In addition to on office space, it probably has the greatest discrepancy right now between buyers and sellers in terms of expectations on values. Another firm surveyed out there that across all property types, 61% of buyers think that they should get a discount on a property that's for sale, but only 9% of owners feel one is warranted. On office, that's 95% of buyers who are looking for a discount, because right now we don't have clarity on NOI and how to underwrite it going forward.
How does that affect value then, Paul? I mean, that at some point in any deal, somebody's coming to you to validate that the prices that they've agreed upon are realistic. This sounds a lot more variable. How do you put a flag in the ground?
Well, I think the office is definitely the trickiest one right now, trying to figure out, the impact of COVID relative to, do we need more space versus the work from home? Do we need less space? And all those leases that are going to roll over, are you going to shrink? Are they going to leave? It goes back to just what Nick said. It's probably the hardest property type right now to actually value because of those unknowns. And as Steve alluded to, it's just now moving to the time where people are beginning and trying to figure out how to make decisions on that property type. And that's different than what we're seeing in multifamily and in retail that's grocery anchored or Dollar General type retail. I mean, those things, there's definitely a lot more activity around, and the pricing is a lot clearer. It's not that hard to value those things. They haven't really changed that much. And the other thing, I know Nick talked about the overall, change in deal volume, and particularly at the larger deal points. What we've seen is since a substantial decline in activity in April and May to what we've seen now in September and October is the overall volume coming through the banks is about back to where it was pre-COVID. But the deals are smaller. They're all, you're less than $3 million deals. There's just a lot of activity out there. There's a lot of owner user activity out there, refinancing, and particularly like on the industrial side or small office building side, you see a lot of owner users buying properties or refinancing properties. And that's all being driven by the interest rate part of this outcome from COVID. So there is a positive aspect at least, but it's at the smaller level because there is volume there, and that value, there's a lot more clarity in those values than there is, like I said, in the office space.
Again, I'm going to add to Paul. I hate to keep jumping in here, Jeff, but just 30 seconds for me. And this goes to Nick as well. There is impairment in the marketplace, and it is, as I said earlier, we build assets to stand the test of time, 40, 50, 60 years. Don't make short-term decisions based on a short-term market cycle. This is going to be handled. And if you do not believe that we can get our hands around this pandemic, that we can get our hands around this virus, that science will not prevail, then you might as well stockpile your toilet paper and rice and pasta and go home. This is going to resolve. We look at things from a 40 to 60-year horizon in our investment cycles of what we build. It is going to be a struggle, depending on the industry you're in, whether it's a year or it's 3 years in hospitality, restaurants, retail. I mean, retail has to answer the question, do my bricks and sticks retail customers come back, or is this dramatic shift to e-commerce that has really created record sales for many companies going to be a permanent thing and permanently impact retail? We don't know, but we can't let it have us making sales decisions now. Now, some people who are not properly balanced and reserved need to transact some assets, and I understand that, and that's a shame. But if you don't have to, get smart and get productive and work into the cycle.
You touched on something that yesterday, Steve, in your press conference for 75 Hopper Place about the retail, which was sort of a requirement of the city. I'm not sure how you folks felt about putting that in. Part of the rationale for that was that, hey, the tenants want to have that kind of thing around. That's part of the whole amenity movement. Kim, are you seeing with the realities of the market, which is it's tough to attract a retail tenant to ground floor, regardless of what's above it or behind it. If ground floors stay empty for a year or two, does that have any impact on the user's demand for it? And was that demand sort of overblown at some point?
I think the users absolutely like the live, work, play environment. And I think if retail does not come back strong quickly, it's going to impact those locations. But I think it all stems to what Steve mentioned earlier, and that's that, it's going to come back. It's just a matter of when, and we don't know that end date. But, companies really love the amenities, and they actually love to be around each other. So know that a lot of the requirements we've done, like that has been the #1 requirement. And it's, we want to be around other people like us. So if you kind of look at where they're centralizing, the retail then came after a lot of those companies. So it is going to be an impact, but I think it's going to come back, and I think it's going to come back pretty strong. It was tough. I was walking through downtown yesterday. I couldn't even believe, hotels were closed, Starbucks were closed in many locations. It's amazing. But I think they're going to come back, and they're going to come back strong, and we're going to be fine going forward at some point.
Nick, in hearing this, one of the things that pops into my head, maybe this is too abstract for this kind of discussion, but what would you say in terms of the share, if you will, of the equity folks that you run into day in, day out have a horizon like Steve's describing, versus the folks that are looking to be involved in a deal and get out of it in 3 to 5 years? And are you seeing that as having any change, any impact on the market right now?
I think in Pittsburgh, we're primarily a buy/build and hold market. So yield appreciation here, we don't have the speculators. We haven't, and I don't think we will, that people come in and flip a deal. This is a market where you finance a deal properly, you get a great cash flow, you pay great distributions to your partners, and over time, the property is worth more than you built it for or bought it for. So I don't think that will impact. The one question here and elsewhere is, there are a number of distressed assets right now, and they are being supported through forbearances or restructurings with their lenders on 3 and 6 month bases. At some point, the gig's going to be up, and some of those properties are going to have to be disposed of. And I think there will be opportunities over the next year, whether they have CMBS loans on them or just some lenders that have to liquidate that holding. So I believe there will be opportunities here in the next 12 months for people who have access to capital, both on the equity side and strong lending relationships.
Well, that seems, I mean, we talk about it as though that's unique, but so obviously in every business cycle, there are people that stockpile dry powder, or people that were just too far out on the limb at the wrong time. Do you see that if Nick's right, Paul, we have more pain next year, and some folks are just going to have to liquidate assets at prices they don't necessarily want to? Is that something that's kind of built into a business cycle, or do you see it dragging values down to where it becomes an impediment in the market?
Yeah, I don't think it's going to drag values down to where it becomes an impediment. I think maybe in the lodging sector, could be a potential oversupply that could have impacts on values other than just what the income situations are. But I think it goes back to what we did have in the previous recession, where we talked about extend and pretend. And that's kind of what we're getting into, and it's a matter of, how long you want to pretend. I don't think for most property types, asset classes, there's going to have to be that long of a period that we're, extending and pending. But the people that didn't have the financial reserves and weren't able to meet the terms of loan, that's where the issues are. But I mean, I'm optimistic from the standpoint of, what Steve had indicated before, that, this is going to end. We get to the vaccine, things will begin to restabilize. And while some property types are going to end up looking substantially different, overall, I don't think there's going to be, foreclosures causing an overall excess supply, which would, diminish values across the board.
Very good. Probably a good place to stop. Brandon's going to show the poll results here. While people are taking a look at that for a moment, I think it's worth noting that extend and pretend worked. We derided that at the time, but I don't recall the great wave of the tsunami of foreclosures that was supposed to take place in 2012 and 2013, when the 5-year maturities came up, nor in 16 or 17 when the 10 years came up. So perhaps not having that won't necessarily be an advantage. I guess I'll ask for questions now. We've had one already chatted in, so I'll start with that. But I'm not sure what, other than the chat, how we're going to take these questions, but we'll start with this one. NAIOP's recent annual meeting noted that the life sciences was going to be a high growth office sector for the foreseeable future. How do you see Pittsburgh's future with that, given the proximity to the universities? Anyone want to take that?
Life sciences continues to be a high growth area opportunity in Pittsburgh. I mean, if you look at the Innovation Works announcement just in the last week, and you look at some of the portfolio companies that are being funded out of Pittsburgh, venture capital groups and angel investors, I'd say their portfolios are probably a third life sciences. So we definitely have that growth sector, and we've had a lot of very successful companies come out of Pittsburgh in the life sciences sector. So I'd say that it's absolutely a high growth area, and I think we'll see a lot of that in the next 12 to 24 months.
Steve, is that making sense in terms of the activity level that you have? Is most of your the interest in Three Crossings, for example, been on the IT and robotics side, or has it been a mix of life sciences?
Well, life sciences as well. And, when you look at our universities and our healthcare systems and the research that they're doing, and, just look at some of the national press that folks are getting locally here with regard to work on the vaccine. And then, Carnegie Mellon, certainly, in terms of technology, and University of Pittsburgh and R&D, these things all play together. Life sciences, technology, all have a place with one another. They're all at the forefront. They're all being viewed nationally. And I do not believe that that's going to slow down. As a matter of fact, something like this pandemic is really telling us a lot more about that our technology can really support life much better, that our life sciences are necessary to be ready to take on the unknown. And so I believe it's going to continue to drive, in our universities and our medical systems here being so strong in both fields are just a benefit that will go on and on for the foreseeable future.
We got a follow-up question to that from the audience, maybe better directed at Paul and Nick. How is Pittsburgh office market faring, or what's your prospects versus the other major markets or its benchmark city markets?
Nick?
I was going to say, Paul. I think our market is doing so on the office side. I think that, when you look at that sublease space, again, that's my concern. Both what is available for sublease now, what is coming up. I know of brokers in the market, leasing brokers, which I am not one, that are not taking calls from tenants wanting to have that broker handle their subleased space because they already have so much of it that they're out shopping. When you look at our sublease space, it's about 2.5% of our market, and that doesn't sound like much, but that's the 4th highest percentage in the United States in terms of percentage of market. So I think the office right now is just a tough go. Again, to what Paul said, how are people going to come back, utilize their space? What rent are they going to be willing to pay? How competitive are landlords going to get on TI packages? Tough as an office, tough one right now.
Yeah, the only thing I'd add is just, I think relatively speaking, central business districts are going to be challenged, particularly if they don't have a tech sector that's driving demand. And, we're pretty reliant on finance and legal in our central business district. And I think when we look at the work from home activity, particularly from those two, and the fact that there's no other real demand drivers for CBD space that, haven't appeared over really the last 20 years, I think, the CBD could be in for some tough times.
No doubt. And just to add to that, I mean, these tech companies, they want to be in Steve's Strip District deal. They want to be in East Liberty, Lawrenceville. They have no desire to be in towers downtown.
And I think the other thing, even if they reconfigure space and shrink relative to the tech companies, maybe they don't need as much space, the overall growth in the sector should offset any shrinkage that individual companies do. So, I would look at very bullishly, the Strip and Oakland and the East End overall being driven by the tech and the life sciences and the robotics. That any kind of reconfiguration is that results in shrinkage is absolutely overpowered by the overall growth in the market. Completely different than what the CBD is.
Well, shifting gears, we have a question about the multifamily market, especially with the delay and the stimulus that we're dealing with. How is that market looking right now?
You want to go first, and then I'll contradict everything you say.
Sure. I mean, from what we've seen is the B and C market, the small apartment deals, and I was alluding to before about a lot of activity. There's 2 or 3 bids on apartment appraisals every week that are either being sold or refinanced. And I'm talking properties that are, 50 years old and have less than 100 units. There's just a whole lot of activity. And that, again, is all interest rate driven. Relative to new development, I think we're in particular, and all the new development is really taking place in the fringe area, a little bit in the CBD and East End. There's nothing going on in the suburbs except for A&R has a few projects around. And I think it's just going to be a pause, but I think it's going to pick back up and take off at the volume it has after, a year, 18 months.
I think the multi-market in terms of, operationally, sales-wise, investment-wise, is showing incredible durability, but it is showing more weakness, a little bit at the fringes. The traffic is down, and I think that, it's what we're hearing, the reason for the folks is there's not as many people working downtown, and therefore the new employees or the employees who wanted to be closer to work are putting off that decision. We are seeing more of a reason for leaving apartments on a retention basis to buying a home. I think that people are interested in some permanence, and they might be accelerating their decision-making process in their life to might as well just get on with it and leave the urban context a little bit earlier. But overall, we're seeing very little movement. Like I said, a little bit, but not significant, and are very bullish on the market. I would say that I think that if you're going to look at doing anything in the urban fringe or CBD, you've got to be very careful about product type and price point. And I think you have to find a way to serve a different market than was served from 2012 through 2019, and find a way to add some affordability, find a way to add some workforce, and find a way to possibly get some rental luxury, because while our marketplace, you might consider to be priced like luxury, it's not the same. But nobody's doing it because nobody knows if there's any market demand or depth. But then again, who would have thought 6 or 7 years ago that the average price point for a condominium in the Strip District would be over $500,000, and the townhomes would be selling for $1 million on Buncher's property? I mean, you just would have never thought it could happen, yet the demand, especially for the townhomes when you saw them fly off the shelf, was staggering.
As someone that tracks that market, I can tell you that that's, there was no precedent for any of that kind of stuff. Chuck Hamill's adaptive reuse of that, the old Fastenal's building. I'm sure everybody that was as smart as me looked at that, shook their head, and couldn't understand how in the world anybody would think that they could get 12 people to pay over $1 million to live in an old warehouse. And I think Chuck's answer was, well, I only need 12. And it turned out it wasn't such a stretch. Yeah, we've consistently underestimated the depth and breadth of the market here for a lot of luxury, whether it was restaurants, whether it was hotels. But I will say, having just completed the third quarter data research, the multifamily market here has not, it's done more than just skip the 60 to 90 days that the pandemic hit us. We may not hit 1,000 units started this year, which will be, that'll go back about 10 years before we find a slower year. So, you said hit pause. That sounds exactly like what's going on. Well, we are getting towards the end of the hour here. We want to be respectful of everybody's time. I know a couple of you have to get off. I don't know if there's a last question, or Brandon, you want to jump in here and wrap things up.
I don't have any questions, but I'll say one thing to everybody listening. First, thanks for putting up with us. But secondly, with regard to COVID, I have a very positive outlook. This is a terrible situation we find ourselves in. Exercise common sense, be safe, help the market get back on its feet by being responsible, and we will get through this.
And I think the only thing I would add to Steve's point is, I think that we will find a vaccine. We will get therapeutics. We'll get through this. As Steve said, it may take some time. Commercial real estate is a lagging indicator, but we have a very diversified, resilient economy here in Pittsburgh with the eds, meds, tech, financial. We weren't overbuilt going into this. Underwriting was very solid. We have great equity and lending relationships here in Pittsburgh. So we're going to be fine. It's just going to take a little bit of time.
Yeah, we have an amazing commercial real estate industry here with a tremendous knowledge base and a lot of creativity. So I think we continue to work together, and it's going to work itself out for sure.
Yeah, I think we're in much better shape we were compared to the last recession, and it's just patience and time.
Well, given that we have developers with a 40 to 60 year timeline, that time we got. So we'll close on that note. Thank you all for participating. It's been fun to hear what you're thinking.
What a great discussion, guys. I appreciate all of your input. And just want to thank everybody who joined us. Our next chapter meeting is in November. It'll be after the election, and it actually is a post-election event. So we're going to have John Delano, who will be joined by a panelist of elected officials and campaign folks. So it'll be a great event. Probably next week, you should all receive an invitation. So again, appreciate you joining us, and that was a great discussion. I want to thank Jeff and the rest of our group that joined us. So have a great day.
Thank you. You too.
Thanks.
Everybody.